Hello, everyone. I'm your host, Cam Webster, and welcome to The Art of Boring, the podcast where we dive deeper into Mawer's investment philosophy and thinking in order to help you, our listeners, become more informed investors. Ultimately, we hope to connect you with the people at Mawer who find excitement in delivering on Be Boring, Make Money. On this episode, we speak with Vijay Viswanathan, our Director of Research and Co-Manager of the Canadian Equity Strategy. We talk about potential trade war impacts, the opportunity set within Canadian equities, and take a deeper dive into portfolio holdings in the energy, e-commerce, and insurance industries.
This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Any views expressed in this podcast are based upon the information available at the time and are subject to change.
Joining me today is Vijay Viswanathan from the Canadian equity side of the business. I guess, Vijay, you're also Director of Research, so welcome.
Thanks for having me again, Cam.
Yes, again. You're a frequent flyer on the Art of Boring podcast, so yes, welcome back. So we thought we'd have you on again just to speak specifically about Canadian equities. But before we do that, what we've been doing with guests lately is just asking them to give us a little bit of their background, how they ended up at Mawer, and their progression through the firm. So over to you for that to begin with.
Yeah, so I joined the firm in 2007, so August of 2007. At the time, or before 2007, I was going to school doing my MBA at the Ivy School of Business, and through the sort of recruiting process, came across this, at the time, was a smaller firm based in Calgary. Decided to apply because that's what I wanted to do, is work buy-side investment management firm, although I didn't really have much of a desire to move to Calgary. But it ended up working out for me instead. So I got the job, and I thought, this could be fantastic. Get my foot in the door. I'll work for a couple years, and I'll move back to Toronto where that family is and everyone is. And then I've been here for 11 years. So yeah, okay. So I joined in 2007, just like every other analyst who comes into the organization. I did a rotation, and that rotation took me to looking at companies all around the world with different market caps. It's one of the good things about the rotation.
Yeah. So
I did that for about a year, and then that the intersection of what was best for me and what sort of played to my strengths and what was going to work best for the team led me to Canadian equity. And part of that was Canadian equities. Working on that asset class was going to afford me the opportunity to do some of the other things that I wanted to do within the firm on the leadership side. So that's kind of how I ended up working on Canadian equity, and that would have been I would probably been more dedicated to Canadian equity starting in 2008,
mm-hmm.
working with Jim Hall. And yeah, I've been working on Canadian equities ever since.
Okay, so you've got a decade of experience to share with listeners on Canadian equities. So yeah. That's a big driver why we have you on. I just want to clarify a little bit for listeners that, like, any new analyst who comes in the door now is still doing that rotation. Is that right?
Yeah, absolutely. We think that's a very important part of our onboarding process. It gives a new person perspective, again, looking at different types of business models and different jurisdictions, different market caps, and maybe most important is working with different people and seeing, what's going to be the best fit.
Okay, great. So that's a little bit of background on Vijay, and thanks for sharing that. So what I want to do now is kind of get into the guts of why you're here today. So what maybe we can cover is kind of some broad issues within Canadian equities, and then maybe as we talk about that, probably talk about a few specific holdings in the portfolio. So,
okay, sounds good.
Why don't we start with probably the most burning question I think listeners want to hear is, if NAFTA falls or there's other trade barriers that go up, how does that impact the Canadian equity portfolio?
Yeah, that'll be in the news a lot. I imagine a NAFTA headline or a trade war headline is what's probably been in the news every day for the last 3-4 months. And yeah. I wouldn't be surprised if that were to continue. So what are we doing about it? The short answer is we're not doing much.
Okay.
And
well, why?
Yeah, and so the reason why I say that is not because we just don't want to deal with it. It's just there's not a lot you can do. And in this situation, you don't know how things are going to play out. We don't know how things are going to unfold. So, our thinking is that it's not prudent to make large shifts and changes to a portfolio when you don't really know what's going to happen. And I think that the headline noise around trade wars and NAFTA doesn't factor in how I think nuanced it is. It doesn't factor in second order, third order impacts. And a lot of those can be just, this stuff just doesn't happen in a vacuum. It's not something that's static. It's if there's a shift in trade policy or there's an increase in tariffs, well, there's reactions by other governments, reactions by industry, reactions by businesses within those industries. So for us, we're not doing a lot. It's not like something I sit there and have sleepless nights over what's going to happen with NAFTA or what's going to happen with increasing tariffs around, whether it's Canada, US, or just globally. It is something we worry about, but not necessarily losing sleep over. And I think we're lucky in the portfolio that at least when we look at the portfolio, there's not a lot that we believe has direct impact to, especially just shifts in NAFTA or unwinding of NAFTA, or even some of the tariffs that we've seen announced. We don't have any exposure. We don't own any companies that are in the softwood lumber business or steel business or auto parts, which seem to be in the crosshairs. The last thing I would say just around NAFTA trade wars is there's the headline and the rhetoric of politicians, and then there's the actual policies that policymakers employ. And I think that's part of the reason why we don't get too far over our skis one way or the other on dealing with this stuff.
Right. And I think one of the statistics globally is something like 15% of announced tariffs have actually been implemented. So where Trump's talking about $200 billion, 15% of that is actually being put through. So I guess that's a nuance as well.
Yeah, I think that was a study put out by Goldman Sachs or some research that was put out by them. And
okay.
Yeah, that doesn't mean that it's not a risk. It doesn't mean that
Sure.
It's just that we don't really know what's going to happen. And so when things become more concrete, then you can see some shifts.
Part of the research process at Mawer is talking to management teams. So maybe are there any examples, Vijay, within the portfolio where you've had a discussion with management team and said, well, let's talk about tariffs. Let's talk about the environment. How are you going to react to it? Are you going to react to it? Do you have a sense of that?
Yeah. I mean, I think it comes up in most of our management meetings because, well, it's very topical. And in most cases, when we've brought up tariffs, it's not one where companies worry about too much in the sense that, well, if something happens is implemented by one country, well, then there's going to be some sort of retaliation by another, and it ends up being sort of a zero-sum game. And so it's not like there's much change. We've talked to some businesses, for example, that have operations, and this might be more NAFTA related, that they have operations in, Mexico, for example, and say, what happens if all of a sudden NAFTA is ripped up and you can't export goods from Mexico? And their take was, well, they probably don't see that happening, but if it were, well, worst case scenario, they'd essentially, they'd find other places to export to, or they would just, mothball that plant and move it or rebuild it or somewhere else, and they could probably do that at a reasonable cost. So I think that comes back to just the stuff doesn't happen in a vacuum, that companies have things at their disposal that they can do to deal with shifts. So it's not, I think it's fair to say that in our discussion with management, there's not been a lot of worries around trade wars and NAFTA. But I think a lot of the management teams in the portfolio are in the same camp as us, where it's like, well, let's see how it plays out, and then we'll be able to give a more fulsome answer.
Right. Well, I think we explored that topic deep enough. I guess on the subject of deep, let's talk about energy. Some of that oil is deep underground, some is not. So that's my transition.
Yeah.
We have a decent weighting as far as Canadian equity goes, but we're underweight the benchmark. So let's talk about maybe some of the reasons why two holdings within the top 10 in the portfolio are energy companies.
Yeah, so I think you mentioned we have a decent sized weight. It's 12% of the portfolio, a little over that. That's a pretty sizable weight in the portfolio. You mentioned it was lower than on a relative basis for the index, but I think it's very important that people our listeners know and our clients know that we don't care about benchmark weight. We're benchmark agnostic. I always say that you can't beat the benchmark if you look like the benchmark. So yeah, it's a big weight. I think 12% is a big weight. Just to give perspective, we have a little close to 18% weight in banks, and I'd argue banks are a better business model than a lot of energy companies. But anyway, you asked. We can probably get to banks at some point, but you asked about energy.
But even the 18% is benchmark weight in banks.
Again, I don't care. The only time I ever know about benchmark weight is when you bring it up to me in conversation.
There you go. The institutional portfolio manager trying to go relative.
So I don't pay attention to the benchmark weight. So let's talk about energy. It's 12% absolute weight in the portfolio. And so two of the bigger positions would be Suncor and Canadian Natural Resources. I think that's what you're alluding to, two of the larger positions in our portfolio, that energy producers. So yeah, energy is an intriguing one. I'm glad you brought up just my history at the firm, and it's interesting to see how both these companies have evolved over that decade plus.
Right. Okay. Have we held them for that long?
We have. Suncor for probably the whole time, Canadian Natural Resources for most of it. So the commodity business itself is, it's a tough business. So commodity business is tough.
Why is it tough?
Well, the biggest reason is you're a price taker, right? You have no say on the price that you're able to sell your good at. So that makes it a tough business and can be very capital intensive. And a lot of times is you got to put a lot of capital up front. In this case, it's a mine up in Fort McMurray into the ground, and you don't see the cash flows for a long time, maybe a decade plus. So you're making assumptions around what kind of returns you can get on projects, now, and you're not going to see the cash flow for 10 years. You don't even know what the price is that you're going to be able to realize on that commodity 10 years from now. So it's a tough business, but this probably gets back to the why do we have, a large weight in these two particular companies. And the big reason is, well, there's two. One is over the last decade plus, both Suncor and Canadian Natural Resources, and I think a lot of the industry has done that, but we're talking about these two companies, have done a significant amount to reduce their cost structure. And I think when people think about investing in commodity companies, we get very caught up in the headline of what's the price of oil, or what's the price of potash, or what's the price of whatever it is, the commodity that you are producing. And the price doesn't matter. What matters is the margin you make per ton, per barrel, per ounce. That's what matters. So if the price of oil is $1 million, but your cost is $1,000,001, that's a crappy business. So it's not the price, it's the margin. And I think what we've seen with these two producers is a significant reduction in their operating costs. And that's happened over time, and that's happened as they've gotten better at mining the asset or pulling it out, pulling the hydrocarbon out of the ground. They've gotten better because of technology, and that's helped. And it's created an environment now where at these price levels, even in a sort of $50 to $70 price environment, both these companies can make pretty decent profit, pretty decent margin per barrel. So that has been a big shift. That's one. And the second one piece, and again, this is nice to have this, I guess, this perspective over the decade plus, is that both these companies spent a lot of money to get their facilities up and running, to get these mines operational. And that capital expenditure, that cash outflow, is behind them. So now you have a good cost structure in place that's getting better. You're able to earn a decent margin on each barrel that you're able to produce. And you don't have to now spend a whole bunch of money because you're still building out your facility. You're still doing all of that. Essentially, you have this cash flow that's left over for shareholders. And so that's why we like it where they are now. They're very much in manufacturing mode where it's all about producing the asset, sweating the asset, and that's going to generate a significant amount of free cash flow, which then can be returned to shareholders in the forms of dividends and share buybacks. Maybe it's opportunistic acquisitions, any number of things. And that's where, for us, the big thing that we spend time on with both these companies, again, this probably speaks to why do we talk to management, and it's like that's part of it. Like, what's management going to do with this cash flow? And that's going to be the difference in how these two investments turn out over time, is what management does and management's actions. And we're confident in both teams, and that's why the weight's where it's at.
Okay. So the proverbial wall of cash is Coming back to shareholders, is it?
I heard about the wall of cash in 2007 and 2008 when we met with the management teams, and they said it's coming, and it appears to be coming. It appears to be coming. Okay. I guess the final piece I'd say on both these companies too is it's not just the quality of the business, which I think has improved materially for where they are in the cycle, but it's also the return potential. So for them, it's we think when looking under reasonable valuation assumptions and commodity assumptions, like what's being priced in it's reasonable when we look at global supply and demand. So it's not a carte blanche that we think all energy companies are going to do well. It's specifically, well, you can see based on the weight in the portfolio, we think there are two in particular that we think should perform well over the medium long term.
Great. So thanks for the overview on energy and why we own those two companies. Hopefully that's only 12% of the podcast time. We'll just proportion everything here. No, really. I wanted to just transition a little bit to the opportunity set in Canada. So the Canadian equity portfolio is pretty concentrated, roughly 10% of the available universe, if you look at the benchmark. So why don't we cover a little bit of that, Vijay, in terms of how the team's approaching finding new opportunities and maybe what that opportunity set looks like today?
Well, yeah, it's a double-edged sword, I guess, Cam. So if you look at the investable universe, so 75% of investable companies in Canada would fall into financials, energy, or materials. So it's not a very diverse opportunity set. There aren't a ton of companies out there that we don't really know about. And so I say it's double-edged sword in the sense that it's not like our global small cap asset class or international equity where you have this very significant universe of opportunities to go and hunt and look for good ideas. I mean, in Canada, it's like, yeah, there's not, we sort of know most of the businesses that are out there. And if they're not in the portfolio, they're on the inventory list. And the other piece, which I think has served clients very well over time, the clients of Canadian large cap, has been that we have Canadian small cap mandate. And so over time, we've seen a lot of companies that have started out as smaller cap that have had a lot of success, that have been a part of our Canadian small cap mandates, the New Canada Fund, and seen over time that they grow to a market cap size that that Canadian large cap is able to take a position. And we've seen that numerous times. And so that's another place for idea generation. So I think the biggest idea generation spots are from our Canadian small cap teammates, but then also just knowing the universe, and there isn't a ton out there that's investable. And that's why we have our inventory list where we know we have a bunch of companies that are on there. And then if the opportunity presents itself, then we may or may not take a position.
Okay. So two things come to mind with that answer for me. It would be Shopify's in the portfolio. It's a little bit over 1% right now. Why is it in the portfolio? What's the investment thesis? What are the risks?
Yeah. So I could talk about why we own it. I mean, Shopify has got we think it's a fantastic business model. So essentially there's two ways they make money. One is they provide the mission critical software for a small or medium sized business to run their business. So that's a recurring revenue stream. You've probably heard recurring revenue stream on a recurring basis on this podcast.
Yes.
For those listening, is a business model that
we like.
So it's a software business that's recurring. That's a big chunk of their business is that. And then not only do they have that, but the other way they make money is that they actually take a cut. They take a percentage or a commission or a royalty or tax or whatever, however you want to describe it. They take a percentage of merchandise that's sold through their platform. And that percentage is somewhere around 2%. Don't quote me on that. So it's a pretty good business model. You have this recurring revenue stream from this mission critical software that they're providing to their customers. And then they're also taking a royalty, or they're taking a piece of the sales of those businesses over time. So we think it's really good business. There's not without its risks. Small and medium sized businesses have really high churn, because you think of, for 10 small businesses that start, maybe one or two survive. And so you have a lot of churn, but the ones that survive a lot of times will thrive, and then you can grow with that business. And so where it's like there can be this disconnect, this valuation, it's like, yeah, it's on a lot of conventional metrics, it may look expensive, but where we land on it is that what's being priced in is not out of the realm of impossible. That's not the realm of complete disconnect from reality. And how we square all that is that, we think the quality of the business this is one of the better businesses that we've come across in Canada in a while. Return potential, there's a pretty wide range there, and but could see how things could play out where it could make sense. Can see many scenarios where it doesn't make sense, and how you balance those two as a portfolio manager is in the position sizing, and that's why it's one where it's actually one that we started with a much smaller weight, and it's just grown to the weight it is in the portfolio because it's been one of our best performers.
Gotcha. So I guess one distinction maybe I'd like to make for listeners on Shopify is the fact that it doesn't just do business with Canadian companies, right?
Yes, that's
right.
It does much significantly more business outside of Canada.
Right.
I mean, U.S. is their biggest market, and they are just really starting the process of going internationally. And so, that could lead to a pretty sizable addressable market for them. And so we'll see how that one plays out over time.
I want to transition maybe a little bit to, I guess, Jim Hall's role. And I know he's been talking to the insurance companies. So that's more the last maybe area I wanted to talk about with you in the portfolio is just where are the insights out of Jim talking to insurance companies? We're in a rising rate environment that probably helps insurance companies, but why don't you walk us through the thesis there for the portfolio? Jim's
co-manager of Canadian Large Cap, and he's a very good analyst as well. And you should bring him on the pod to talk about life goes as opposed to broken telephone through me. So Jim has done a bunch of work on life. Well, we've done a lot of work on life goes as a team. And so, what are the takeaways? Well, I think this notion, so life goes are misnamed, and I think banks are misnamed too. And I'll tie the two together in a second, is because they're not. Like life insurance is like one of the smallest parts of their business. They're really financial conglomerates. Same with banks. I mean, banking is a big part of their business, but they have other pieces that are very sizable as well. So in the case of Lifeco's banks, these are financial conglomerates. In the case of Lifeco's, a significant part of the business is wealth management. That's where they want to grow their business. That's where they have been allocating capital to grow their business.
So what's the why behind that? Why are they presuming
higher returns?
Okay.
Right? I think that, so if you look at the life insurance business, it's a commodity business. Now, what's good about it in Canada is that it's an oligopoly. But again, you're selling a commodity. If any of our listeners here have applied for term insurance or, other, I sell basic insurance products, it's like there's no pricing power. There's no real differentiation, right? It's like everyone's offering the same thing. But the market structure is good in Canada, so can make it reasonably profitable for Lifecos. Where the growth has come is from wealth management needs. That's where they've been allocating capital, trying to grow that. And then if you look at least the Canadian landscape, not all, but most, and I can talk about Manulife, which is one that's in the portfolio. Canadian operations, while sizable, that's a big part of the business, but a lot of the growth and a lot of where the profitability comes from is from outside of Canada. So each one has their own sort of strategy. So if you look at, Manulife, the big focus is on wealth management. It's on focusing on Asia.
For Manulife, would more than half of their revenue or half of their profitability come from outside of Canada?
Okay. Absolutely. And so that's one that's Manulife. That's their strategy. That's what they're moving forward. And I think what's going to make or break that will be a couple things. One is they got to deal with the legacy U.S. business they have, and they are doing that. And then they have to grow in Asia. I think that's a big part of the next leg of the journey for Manulife. I think most life insurance companies are all sort of do have a similar strategy in place. And if you go back to 2008 financial crisis, a lot of Lifecos got into trouble, and so some more than others. And so they've done a lot actually, to de-risk their books of business. They've hopefully learned from lessons of the past, and they're not writing unprofitable business that have sort of long tails to them. And I think that's the big push to wealth management, which is, less capital intensive, higher returns on equity. It's less pressure from the capital regime and higher growth. And so that's where most of them are participating, and that's where most of them are allocating capital. And so we think that that's a positive. Valuations look attractive. So I think that's important. Again, it's not just quality of the business, it's the return potential as well. So I think business models have probably improved because there's a little bit more wealth management. They should probably be in a decent position competitively there. I think management teams have improved. They de-risked business models. Valuations look pretty attractive, especially when you compare them across the universe. And then you got what could be a decent tailwind, depending on what company you're looking at. If you get specifically, whether it's in Asia with growth there, Manulife, you might get some macro tailwinds from higher rates over time, although a lot of the businesses have sort of hedged out some of that upside over time. So I think it's an improving business model. Seems like better management teams, decent valuation, not without its risks.
So we've covered a little bit of energy, what some would perceive as a high flyer stock and why is it in the portfolio, and a little bit on insurance and kind of the analysis behind that. So thanks for sharing that kind of quick overview of some of the aspects of the Canadian equity portfolio. Mm-hmm. What we like to do now, Vijay, is the last time you were on, we did like a rapid fire round.
Yeah, I remember.
We've condensed that into a single question called One More Thought.
One More Thought.
And so what we do is, based on my knowledge of your personal interests, delve into that and ask you to connect it to how you apply it in investing.
Are you going to ask me the question, or do I have to come up with this one more thought?
No, I'm going to. Okay. Well, you can totally just go.
I'm waiting for the question.
But the question would be,
jump the gun.
I know you're a sports fan.
I am.
Broadly a sports fan.
Mm-hmm.
Pretty similar to the Canadian equity universe. It's broad. Mm-hmm. So within that, I know you're a cricket fan.
Yes, I am.
So can you connect cricket to investing for us?
Can I invest? Can I connect cricket to investing? Yeah, I can.
Okay. Please do.
I will. Well, so cricket, and it's funny. I don't know whether our listeners care about cricket, but for those who, my favorite form of the game, cricket, is a test match. There's different forms of the game. There's your 2020 version. That's the short version. There's a 1 day international, they call it. It essentially takes a day to play. And then there's a test match, which is 5 days to play. So that is the form I like the most because there are so many ebbs and flows to that match, because then you're playing over 5 days.
5 days, like how long in 1 day?
Yeah, like I think it'd be a whole podcast where I could explain test cricket, which I don't think is where you guys want to go with this. But, so I think where I tie it in is at the end, you're trying to win the match, and there's going to be lots of ebbs and flows along the way. And I think one of the key things from test cricket, the teams that have been the most successful, the test cricketers that have been the most successful over time are the ones that have exuded the most patience. And then when the time is right to attack, or the time is right, they do. And they try to take advantage of that. But I highly recommend to watch a test match. But that's how I would equate it to investing. This combination of being very patient, and then when you get the opportunity to attack, or that take the opportunity to score runs. That to me is how I tie the two together.
That's an awesome way to tie it together. I guess I have to allocate 5 days somewhere in my time to watch a test match.
I'd be more than happy to watch test match.
All right. Well, thank you for being on, Vijay. We'll have you on again. We'll issue your frequent flyer card soon, and thanks again for taking time.
No, thanks for having me.
Hey everyone, Cam here again. To subscribe to the Art of Boring podcast, go to Mawer, that's mawer.com/podcast. If you enjoyed this episode, leave a review on iTunes, which will help more people discover the Be Boring, Make Money philosophy. Again, thanks for listening.